All right, and in the previous discussion, we talked about the psychology of trend formation, and in this session, we want to get acquainted with the first ICA reversal pattern in technical analysis. The first reversal pattern in technical analysis is the head and shoulders pattern. All right, let's get familiar with the schematic representation of the head and shoulders pattern and see how this pattern emerges. As you can see in this image, the head and shoulders pattern is among the category of reversal patterns. This means a pattern where the price chart of the stock, look at the chart that I am actually showing here. It's a chart with an upward trend moving forward. This upward trend continues until you see a peak and another peak of the same size next to each other with a much larger peak of the stock's price chart formed between these two peaks. The peak you see here is what we call head. The left peak is the left shoulder and the right peak is the right shoulder, which we refer to as the left shoulder, i.e. right shoulder, and head. This is where the head and shoulders pattern, meaning two shoulders of equal size and a head, is formed. Our head and shoulders pattern has been formed. Note that these two shoulders, mikatais, left and right, when they connect to the head, create two valleys. These two valleys that you see here. From the geometric location of the connection of these two valleys, we draw a line which we call the neckline. The neckline, after the right shoulder, intersects the price chart of the stock at a point. This point, dear friends, is our breakout point, which we have talked about before. When the breakout point is created, from the breakout point onwards, we should actually see the target of our head and shoulders pattern, which, if you want to observe the target here now. In this situation, we observe that, pay attention, we have talked about it before, at least, or at a minimum, by the distance from the neckline to the head, from the breakout point, meaning around the breakout level, we will witness a drop in the stock's price chart. Why do we have a drop? Because our pattern is a reversal pattern, a returning pattern, and the target that this pattern gives us indicates that the chart should drop afterward, meaning that a chart with an upward price trend should turn into a chart with a downward price trend. And always keep in mind that the certainty will be at least to this extent, if not more. So when you keep this pattern with its schematic representation in your mind, you realize that when this situation occurs on the price chart of the stock, we witness a drop in the stock's price chart. You should try to repeatedly view the schematic representation of price patterns and repeatedly attempt to identify them on the stock price charts over past time periods. When you recognize these, they gradually become second nature to you, and you learn to identify patterns at first glance on a stock price chart. A few important points. 1. WAPA. Not all stock price charts are required to have a mandatory price pattern. Price patterns may be observed. On a stock price chart, they may or may not be visible, but the point is that when you see them, you should know that after the pattern is formed with all its schematic representation, we will actually have that price target after the pattern is established. The second point is a golden rule, which is our golden rule in technical analysis, and that is when you look at a stock price chart, you should be able to identify the pattern with its schematic representation within the first 30 to 45 seconds. If you cannot find the pattern within this time frame, there is no need to try to find a pattern. This will actually increase your error in pattern recognition. Of course, the point I need to tell you, dear ones, is that when you are just starting to practice and get familiar with the patterns, from the very beginning, there is no need to worry about this golden rule of technical analysis. You are currently practicing But later, when you practice more and become professional, know that you should not spend more than 30 to 45 seconds trying to identify a pattern on the chart. And this is the golden rule of technical analysis. Well, I showed you this example. I showed this schematic view. Now I want to show you a few real examples from the world of the stock market and see how fascinatingly this pattern we practiced together has occurred on the charts. And we actually saw this on the charts.